Hello, welcome back to our channel, Buffalo First Wealth Management with Alan Dembski and Juliana Jansen. Today, our topic is financial rules of thumb debate. So this is a good one because we see these all the time. People come to us with these questions and we see it all over the internet, actually. This is, again, our own take on things, which could be different from yours. And we would love to hear about it, actually. If you disagree or agree with us, we would love for you to comment and share our videos. The first one is we could probably spend the whole time debating the 4% rule. I hear this probably once a week or once every other day. Like that's how much the 4% rule comes up.
Well, and it's an oldie, but a goodie,
Yeah.
actually. It's been around since the 90s. It's credited to a financial advisor called William Bengen. And it's actually not just the 4% rule. Sometimes it's called the Bengen rule, actually. And basically, it's long been considered the gold standard for the amount that a retiree should be withdrawing from their savings. But one of the problems is right now, retiree doesn't have one definition. A retiree could be a 55-year-old, a 65-year-old, a 75-year-old, or it could be a 45-year-old, depending if they're part of the FIRE movement.
Yes. Absolutely. But the 4% too was really credited years ago to interest rates where people, I'm getting 4% on my money that I can distribute the earnings on my money to help support my lifestyle. And that in low interest environments over the last 15 years, that's not necessarily the case that you're getting 4% on that. So there is some flaws there, when it comes to spending. And like you said, well, what if I'm living a lot longer? Or what if I need more than 4% of my money to live my lifestyle that I want to live? So I think, when people come to me, I always tell them like 4% might be like, let's start there. But how much are you going to spend in retirement?
Well, and also, what other forms of income do you have? Are you receiving a pension? Do you have annuity income? There are a lot of different factors. What is your Social Security income? Are you part of a dual income family where you're going to have some pretty substantial Social Security income? All of those factors can impact what the right withdrawal rate is.
Right. And, what if one spouse deceases and then I don't have any more Social Security coming in from that spouse? How is that going to affect my distribution rate? But like all these, the next few that we're going to discuss are just rules of thumb and different strokes for different folks, I guess.
And for me, I love the fact that people are talking about this stuff. So as long as we're talking about it and people are getting help from an advisor that can help them, then all the better to have that be a starting point for conversation.
And if you don't have an advisor, you can certainly reach out to us at Buffalo First Wealth Management.
Yeah, this is the stuff we help people with all the time.
Yeah. I love the 4% discussion because people hear it all the time and it's been around for such a long time, and it's a fun one to debate with clients. So next up is the 50-30-20 spending rules.
Yeah, and this one definitely has some merit. I think that the purpose of this rule of thumb is people, when you get your check, you need to know, am I on track? I think it's probably the most common question that we get from people, no matter where they are in the continuum of their career, is, am I on track? Mm-hmm. Whatever that means for that particular person. And this kind of gives people some sort of a guide to determine whether or not they're on track. So the 50 is basically your fixed expenses, what you spend every month on rent and gas and electric and your water bill, things that really can't be undone, your car payment, etc. 30% are your wants. So that could be going out, vacations, things that aren't absolutely necessary to be spent. And the 20 is basically the amount that you're saving. And that can include money that's going into your 401k, as well as savings for other shorter term, saving for a house or saving for your kids' college. And it definitely has some merit.
Yeah. I think the 30%, and I've talked to people about this before, is some people classify food as a fixed expense. I think your grocery bill can be also a variable expense where you can control. I know sometimes it's not convenient to shop at two different places when you're grocery shopping. I know my wife would be yelling at me right now for saying that. But there is some merit or some savings if they are close by, where you could potentially buy some brand names versus generic. You can kind of save a little bit here and there. But really, when we're talking about the wants, it's eating out, not so much your groceries, eating out, buying those coffees, Starbucks or whatever it might be. And sometimes 20% for savings might be low for some people, depending on their income when they get older and making more money.
And depending on what their goals are.
Yes.
If your goal is to retire early, 20% is probably not enough to save. But if, depending on how long you plan on working, it can be a good goal for people.
Right. So I think out of the last two that we just discussed, this one might have a little bit more merit than the 4% rule, just to get a guideline or a baseline for your spending. But if you don't track, you don't know, and you could be way off on these numbers.
And a lot of people are. It's rare that people come to us without doing detailed tracking and really have a good handle on what they spend on these different categories.
Right. And the next one we're going to debate here a little bit is, by the time I am X, I should have saved Y.
Yeah. I think these rules cause a lot of anxiety. I think sometimes these rules can be detrimental, because a lot of times, for instance, a 40-year-old, the rule of thumb is that they need to have 3 times their salary saved. And that can be across retirement and non-retirement accounts. So if you have somebody that's 42 and they're making $75,000 a year, and they look at the rule of thumb and think, boy, I don't have anywhere near $225,000 saved. Sometimes what happens is they just say, forget it, I'm not even going to try because I'm so far off. So that's one of the reasons that I don't love these rules of thumb, because different people's income is very different. It's not always a straight line. You got people that are in school for a long time and maybe they're not making much at all, but then once they get into their late 20s or 30s, they've really got their income that's increasing. That's going to be a different answer than somebody that has a more steady increase in their income over the years.
Yeah, for sure. When somebody's 40 years old and they say, I want to retire at 55 and I only have $50,000 saved, I don't know if that's going to happen. What's your retirement goals like? What are you going to spend in retirement to know for sure how much money you're going to need in retirement, or what the projection looks like? Or if I'm 40 years old and I have 3.5 million saved, could I retire by 55? Well, I don't know that answer either, because what are your goals in retirement and how much you're going to spend?
And how much you're going to spend, which is always the first question that we ask when people have the retirement. Well, how much do you spend? Always the first question that we ask.
Sure.
And not an easy question to always answer.
Yeah. And another part of that rule is, if I'm 60 years old, I need 8 times my age or my earnings to retire. And by that time, it's what? So if I'm making 75,000, 8 times that, I should have around 600,000 saved. Well, again, back to our previous point, what are you spending in retirement to know how much money you're going to need?
Yeah. And what other income are you planning on having in retirement as well? People that have pensions, it's a game changer in terms of what their needs are. Their needs are a lot less because they have this guaranteed income that's coming in for their lifetime.
So I think so far it's, well, what if, or but
it depends.
It depends are usually the answers to some of these questions. So the last one we're going to talk about real quick here is the 110 minus your age. So what does that mean, 110?
Yeah, so people, when they're investing, they want to know, do I have the right allocation between stocks and fixed income, essentially? And I don't remember who actually started this rule of thumb, but essentially what it says is you take the number 110 and you subtract your age, and that's the amount that you should have in equities, in stocks. And again, it's a good starting point, but if you have somebody that is just a risk taker and they're more comfortable taking on risks and they don't really mind riding the ups and downs of the market, that might not be aggressive enough. And if you have somebody that is a nervous investor where every time the market drops a little bit, they panic and they sometimes literally lose sleep, that may not be the right asset for them as well. So your risk tolerance is a piece of it, as well as what other investments, do you have rental property that could be a game changer in terms of what your needs are down the line?
And also, too, if somebody is investing and they can handle those market fluctuations, or they understand the market and they want to retire at 65, you still have 25 years of market volatility. And chances are, over history, you're probably going to be up rather than down, where you can take a little bit more risk. But it's really a lot of times emotional, what you can handle, seeing your investment account going up and down. And it's not just a straight line ever in the stock market.
Well, and your point about the straight line, it's not in previous years, the thought was your amount in the stock market is going to keep going down and down and down. But what I'm hearing more and more is it's not necessarily a straight line. It's going to go up and down. So some people are saying those first few years of retirement, say the first 5 to 7 years, you're going to be less likely to handle a major downturn in the market. So you actually might want to have your equity exposure even lower, maybe 50% or 45%. And then as you get older, you might want to actually increase the amount of equities that you have, depending on how much you need and how much you're drawing down. That was kind of mind-blowing for me, because I grew up knowing, or thinking that you just keep decreasing your stock exposure, your equity exposure as time goes on. And that may not be the right move for some people. And
again, it depends on all your other assets, what you're drawing down, where income's coming in, what buckets of money can I allocate in different areas that I'm drawing down on. Maybe that should be more fixed income where I can pull money from. So there's a lot of variables in this rule of thumb, if you will, based on your personal situation.
Definitely. And there's merit to all of them. I think that
Absolutely.
Each of these rules of thumb have some merit. And like I said, as long as we're talking about it, that's absolutely the first step.
Right. But just because you see a rule of thumb, that doesn't mean that it applies to you and that's how you should be thinking. You have to think about it, think about how it applies to you, and then all the variables that come along with that. And that's where financial advisors come in to help you understand those and come up with a plan for your money, whether it's now and to maybe debunk some of these rules of thumb or to endorse them.
Right.
Depending on your personal situation.
Definitely.
Thank you very much. Please like, share our video, and comment if you agree, disagree. We'd like to hear if there's a rule of thumb that you like. Certainly put that in the comments and we can talk about it next time, or you can share it with others. Thank you and have a great day.